It's time to dive into what's likely one of the biggest financial developments of the month, a probable interest rate cut by the Federal Reserve. Right now, we're looking at a massive 98.4% chance that the Fed will lower rates at their upcoming meeting, set for November 7th. According to the CME FedWatch tool, the odds are overwhelmingly in favor of a 0.25% rate reduction, which would shift the federal funds rate down to around 4.75%. But why is this rate cut such a big deal, and what does it mean for you? This isn't just a random change, it's a calculated move by the Fed to address economic conditions in real time. By cutting rates, they're aiming to control inflation, manage job market shifts, and keep economic growth steady. Things that impact our daily lives, from mortgages to credit card rates to investment opportunities. Stick with us to find out how these shifts may affect your wallet and how you can take advantage of this economic maneuvering. So, why a 0.25% cut instead of something more dramatic like 0.5%? Well, that larger cut simply isn't on the table this time. The Fed has set its sights on a gradual adjustment. Just last month, they reduced rates by 0.5%, bringing them from 5.5% down to 5.0%. If the Fed proceeds with this new cut next week, it'll be a smaller but still impactful step toward their broader goals. This approach is part of a delicate balancing act. They want to ease economic pressures without triggering unintended side effects. Here's what's coming up that could sway the Fed's decision. Tomorrow, we're set to receive the latest PCE inflation report, which is a crucial tool for the Fed when gauging inflation trends. Now, if you're wondering why the PCE report is so essential, it's because it focuses on core PCE, which excludes more volatile items like food and energy prices, giving the Fed a clearer picture of underlying inflation trends. In their last report, core PCE inflation was marked at 2.7%, but experts expect this new report to bring it down slightly to 2.6%. The Fed's long-term goal? A steady 2% inflation rate, so as long as tomorrow's numbers don't spike unexpectedly, they'll likely go ahead with the planned 0.25% rate cut. Following that on Friday, we'll get another key economic indicator, the jobs report. The Fed keeps a close eye on employment data because its policy decisions are aimed at stabilizing the labor market. A weaker job market signals potential trouble, whereas robust employment figures indicate a more resilient economy. Right now, analysts are projecting a significant dip in job growth. Last month we saw 254,000 jobs added to the economy, but October is expected to show only 125,000 new jobs, largely due to disruptions from recent hurricanes and the Boeing strike. So, here's how this plays out. If both the PCE inflation report and the jobs report come in as expected, the Fed will almost certainly make the 0.25% rate cut. But if the jobs report is unexpectedly strong, it could give the Fed a reason to pause and possibly hold off on any cuts altogether. On the flip side, if the report reveals severe losses, they may even reconsider a larger cut, though that's far less likely. Before we go on, if you're finding this information helpful, please remember to subscribe to the Elite Economizer. By subscribing, you'll stay in the loop on all the critical updates that impact your finances. So, let's bring some real-world context into this. How exactly does a Fed rate cut touch your everyday life? For starters, lower rates typically mean cheaper borrowing costs. That could make a difference for you if you're looking into refinancing a mortgage, buying a car, or paying down credit card debt. A 0.25% reduction might not seem like much, but it can lead to savings over time, especially if more cuts follow. Beyond loans, rate cuts can also influence your investments. Lower rates often lead to more favorable conditions for stocks, as businesses can borrow more easily and expand. This potential for growth makes the stock market an attractive place for investors during rate cuts. But the Fed's plans don't end here. After next week's decision, the next big date is December 18th. As of now, there's a 74.1% chance that we'll see another rate cut by 0.25% at that meeting, which would bring the federal funds rate down further to 4.5%. Now, why are we expecting another rate cut so soon? It's all about the Fed's long-term outlook. They're aiming to bring rates down to around 3% by the end of 2026. This rate strategy is designed to encourage spending, promote investment, and gradually ease inflation down to a sustainable level. If you've been watching our other videos, you'll know that we're seeing a bigger economic cycle at play here. We're in a unique situation where inflation pressures have finally started cooling, allowing the Fed to consider a series of rate reductions. And as things evolve, they may even bring rates down to near zero levels again, a policy stance we haven't seen since the aftermath of the last financial crisis. Of course, this shift won't happen overnight. The Fed will be evaluating economic data month by month, meeting by meeting. Next week's rate decision is just one piece of a much larger economic puzzle, and with inflation trends and labor markets in the spotlight, the Fed will be cautious in how they proceed. Remember, they're working to balance growth without sparking too much inflation, not an easy task, but one that shapes our economic environment. As we look ahead to the December meeting, there are still many factors that could alter the Fed's course. The economy is constantly shifting, and each new report, whether it's job data, inflation metrics, or other indicators, could change their approach. The decisions they make have a ripple effect on everything from interest rates to investment strategies, impacting not only financial markets but also the broader economy. So as we wrap up, what does this mean for you and your financial goals? If you're considering a major purchase or investment, staying informed is crucial. Whether you're looking to buy a home, expand your investments, or simply save on borrowing costs, understanding these Fed rate changes can help you make smarter choices. By watching economic indicators like inflation and jobs reports, you'll be better prepared for the shifts ahead. Thanks for joining us on the Elite Economizer for this breakdown on the upcoming Fed meeting and interest rate cuts. If you enjoyed this video, please give it a thumbs up and don't forget to subscribe for more personal finance insights. We'll keep you updated on the latest economic trends and strategies to help you make the most of your money. Until next time, stay informed and stay ahead.